Francis, welcome to the podcast.
Thanks for having me, William.
For our audience, Francis Huang is the co-founder of Apers. It is a up-and-coming startup venture focused on tackling the intricacies of complex real estate transactions for income-producing uh, real estate assets. Is
That's right.
that the gist of it?
Well, it's actually more than that, but
Yeah.
that's why we're here, right?
Absolutely. Well, let's dive right in. Why make this startup? Why?
Yeah.
What is this venture? Who is it helping? What's the value behind it?
Absolutely. So, I like to think bigger first, and then let's go down to what we're building and how we're going to tackle that problem. So the number one question, actually, is not just today or last year when we started. It's actually started several years ago when I was in Harvard, the real estate program. It's a master program here. And we spent a lot of time between MIT and their Center for Real Estate in Sloan. And the challenge that I saw for alternative asset as a whole, more than just real estate, is one is super heterogeneous, meaning things are different, right? It's not like stock, it's not like Bitcoin, everything's fungible. It is not. The property you buy here in Massachusetts is different from the one you have in Beijing, even though they may be designed by the same designer, Foster, but they are different. And then we just soon realized the cost for that is just too expensive. 2% plus 20% and all kinds of waterfall structure. And eventually, when we look at the challenges, because the ultimate owners are institutional LPs, limited partners, pension funds, sovereign wealth funds, endowments. But we go deeper. That's actually your money, your pension contributors. That's the money that you hope you can get more when you retire, and that will sustain like your dignity after you're not working. That's a challenge we want to solve.
Okay, so let's dive into the intricacies of this complex real estate. A lot of listeners might buy a house one day, or own a house now. Maybe they're looking at getting into real estate as a more professional matter of development, or to buy and renovate and improve assets, and then hold them and, rent them out. Tell us before the startup, right? Minus the startup, run us through basically what the complexity of what a real estate transaction would be, let's say for a quadplex, a moderate house that somebody would want to buy, maybe a student that, in a few years have made enough money that they want to buy and rent out to a number of people, in addition to their room. If it's a quadplex, there's three other units. What does that look like traditionally before this venture?
Absolutely. So actually, quadplex is quite simple to the world of institutional real estate, but let's just use that as
let's start
example,
at the small,
right? The smallest. So first of all, let's just divide real estate into two different categories. One is residential, another is commercial, or what we call income producing. So residential, like the single family home you see in the ultra luxury one in Bel Air or West Cambridge, Weston, those assets or properties, we see them as a combination of assets and consumption goods. So you're paying for something that could rent out for money. But the other part is we really enjoy looking at the good things. It's like buying a super luxury car, but that depreciates. And that's not what we're talking about.
That is not.
Yes. Another is income producing properties or asset. And we want to, just take it to abstract level. Let's have the definition here is anything that's on ground that can brings positive cash to our pocket. So that means like the triplex, triple decker here in Boston, Massachusetts, or even self-storage. And the most exotic real asset I've seen is windmill. Like you have a piece of land, you have a windmill that generates power, you can sell the power to the national grid and you make money. Even though the cash generated is super, let's say, volatile or non-linear in our world. So let's just go back to your original question. That is an income producing property, which is good. And currently, when you are seeing this type of transaction for example, you want to get your own. There's several. One, can they bring cash, not taking the money out of your pocket? And usually the industry standard is using pro forma analysis to capture the month-to-month or annual cash flow.
Right.
And of course, you need to take care of the expense, right? Utilities, you got to pay the water bill, or Boston Water Sewer Company will sue you and put a lien on it and take your house away. And then, gas, all kinds of bills you need to pay. And then hopefully you can have a positive number left.
Right. Let's say you're, quadplex. Let's say you're making $1,000 unit, keeping it simple. 3 units you're renting out, so $3,000. You have your expenses that overall is $1,500 for the 3 units, and then you're gonna pay mortgage. Let's say another $1,000 on top of that. So at the end of it, let's say you get $500 a month, roughly. That's the income you produce from a very simple, at the most basic level.
That's right. Right.
So what's next?
Okay, so that's where the counterintuitive part kicks in. In the world of institutional real estate or income-producing real estate, the shape of the property doesn't matter that much.
What do you mean by shape?
Okay, this argument might trigger a lot of angers from my friends at the Harvard Graduate School of Design and the architects. But if we just look at the real estate as an asset, this is not artifact. It's not a art piece that will last forever, like Le Corbusier, right? The value, the capital value of the real asset is majorly determined by the cash it can produce and the risk associated with a long-term cash generation. The shape, as long as it's not like super fancy buildings that leaks water every single day, doesn't matter that much.
The shape of the building itself.
The shape, the design. So when we are investing means we want to put some money and hopefully get more money out of it. There are 2 main drivers for the kind of success in real estate. One is you want to make sure you can collect more rents. That means we call it value add. You do something, you hopefully use the space more optimally.
Right, certainly. So for the quadplex example, let's say it was run down, it was 30 years old. It hasn't had a modern HVAC system, AC system. You might put your own money, of course, buying the property, but you put additional money into putting in a brand new roof, brand new flooring and all that, and making a modern house, more modern house. And therefore, you've put the money, and for our listeners, then you would, of course, you believe that previously you might have rented for, let's say $500 or let's say $800. But now the value has increased. It's more attractive to more people. More people want to pay higher prices, and you're charging $1,000 per each of the 3 units that you're renting out. And so that's the value add, right? It's for the good developers, for the good asset managers out there, not for those that will buy a house and just simply jack up the rent. There are those bad apples, but generally, when you're adding value, let's say you've improved the condition of the asset of the property.
That's exactly right. And just give a concrete example, because we're doing something here as well. The example we have right now is we, actually for Apers, I will tell later on, but we managed to use our service to acquire a 3-floor, 2-family property near HBS. And the tenant profile for that property, which has been there for almost 120 years, the condition is pretty bad. And students from HBS like you can live a better place on campus. And this is what we call substitution effect in economics. And unless we lower the rent to a certain level, you wouldn't even consider that. However, the value add we're trying to do is we want to make it update. So you spend the same money here, but you can have a better living condition. And that is the value add we're having in the world of real estate. And it's a super competitive market. Harvard can choose to lower the price, but usually they don't.
Yeah, absolutely. Well, let's talk about a bigger example, perhaps the one that might be more relatable to your venture. Let's say you're buying a modest apartment complex, let's say 30 units, right? Let's say 5-floor, 6 units each. Let's say it costs, that's a good amount. Let's say, Boston, let's say $100,000 that's just roughly 100,000 units. You're spending, 3 million, let's say, for this.
Yeah.
Not real, maybe a little bit on the lower side, but you're buying this. So run us through what a transaction for a little bit more complex a real estate asset might look like.
That's a super good question because when you're going to institutional, your counterparties or the people who are doing transaction with you, as well as the regulation, the zoning law, the legal part, getting more and more complex.
Absolutely.
Actually, in our experience, for example, in Boston, if you're just doing 2-family or single family, maybe 3-family, the regulation overall is pretty friendly. As they wouldn't come to your home every single day. But let's assume you're renovating Four Seasons Hotel in downtown Boston. Everybody will look at you. The people who are selling you the property, maybe they have history. How they get that building was not up to code. And you can only make the decision in a short period of time because as long as it's a really good property, people will compete for that. So the question then, back to the similar thing to the small property we just discussed, of course, you need to simulate or model the cash flow again. It's just more units, not just 4.
Right.
Another is expense, of course, very similar. And then you get the NOI. So where the challenges come from, actually, one, usually we don't acquire like a vacant property, right? We typically have some tenants there. Here in Boston, it might be more friendly because the legal structure is pretty here. But what I have seen in my career is some people, the leases are very different. Right? You have 40 to 100 different leases. Very not so usual in residential apartment, but let's just assume it's office building. John Hancock Tower or Prudential Tower, you can have even more tenants, different different leases, lengths, and then remember, you need to make a 9-figure decision within a relatively short period of time with relatively high level of confidence because the moment you screw up later on can kill your company or your personal net worth. So that's a challenging question for the real estate investor. And that's actually the main reason why people operate locally, because they can manage the risk better. We know Prudential Towers, the tower for a while, at least a few decades, with the tenants. But imagine if we were the sovereign fund of Korea. We don't know that so much. We saw the picture on magazine, but the ability to have a sustainable net operating income. Can they confidently say, yes, they know exactly what's going on? Usually not.
Right. And they would be the LPs, as you mentioned.
And that's why you have GP,
right,
general partners, who knows the local market really
and those are the ones that the LPs give the money to make the investments on their behalf. And of course, the GPs get a nice cut of that if any profits are achieved, as well as management fees. So let's talk about the biggest, most complex. Let's say a big institutional buyer, a GP like Blackstone, for example, or Berkshire, wants to buy a 500 unit apartment complex, across several buildings in their portfolio. What would be kind of the key elements of the transactions that required, and what are the main costs associated with that transactional part of it?
Yeah, that's a super good question, by the way. And I want to take you to a more realistic case. So just imagine you want, as Whitestone, let's say, hypothetical
Whitestone, exactly.
Whitestone, hypothetical private equity firm in real estate, and you want to privatize a real estate investment trust that holds 200 office buildings in America, all over the places.
And for our listeners, a real estate investment trust generally is a publicly traded, essentially stock company that, of course, buys real estate assets and improves them and then redistributes the income, generally a vast majority, back to the LPs or the shareholders, especially if it's a public corporation. You're saying a public REIT that you convert, that a private corporation would buy and convert privately.
That's right. And how you make money, let's say, maybe the stock market crashed and you want to privatize that. And by selling each property privately, you can make a lot of money. Let's just say, long story short. Then the challenge is the opportunity doesn't last forever. And you need to make that decision quick. 200 properties. Can you make the decision within days to give them a confident bid? Because if you screw this up, you will definitely not raise your next round of your fund. Maybe growth fund 4, right? Not going to happen. So, like the best player so far, which is Blackstone, Mr. Schwarzman has a really, really great team, and I know you were one of the Schwarzman scholar, which is amazing. And they actually have over 5,000 analysts and associates globally to tackle that kind of problem, to making sure that they hire the smartest people, and making sure that they know the transaction details. They are the smartest people in the room. But humans are, well, we have 24 hours per day. We need to sleep and we get tired. So let's just imagine that transaction. You're presented with an opportunity to privatize $50 billion portfolio. And if you do things right, you can you can double that money by using only a small portion of your own capital. But if you fail, you lose your shirt.
No, that's the risk, right? Yeah. No risk, no reward, no risk.
That's right. And just sheer analyzing all the properties, it just takes time, and you just cannot afford losing that.
So I guess that brings us to this problem that you presented, especially for some of the larger and larger transactions. And institutional players are playing a bigger role in the housing market, multifamily and single family as a portfolio in general. Tell us about Apers, right?
That's right.
Tell us about what Apers is trying to tackle.
Right. So for now, our slogan is simple. We help institutional investors make higher IRR and a lower operating expense by using all the algorithm and the models we developed internally, as well as the research we had for the past 2 decades at Harvard and MIT Center for Real Estate. Simple as that. It's not today or yesterday. Actually, we have been working on this for a while. So let me just give you an example that a sample case we did for a Boston-based real estate investment trust. So they operate mainly in office market several years ago. And they were trying to redevelop one of the largest transit-oriented development in Boston. And it's a multi-billion-dollar development, and they don't want to screw up. So they actually came to us, that was at MIT by that time. They want us to build a simulation-based model to see the economic value of having flexibility, what we call phasing, meaning should they build everything all at once? Or part 1, let's do this, part 2, let's do that. And the challenge is if you do things later, right, you just cannot exit immediately. It's just taking longer, and usually longer, more things can go wrong, meaning taking more risk. The market could be very different from today. So we actually managed to build them a simulation model just to imagine, given the market assumptions we have, all the parameters we can observe, capital market, asset market, rental market, as well as Boston local economy. And then we simulate the future 5 years to 10 years over 10,000 times. And essentially, we're not trying to get a crystal ball because there is no such thing. And anyone who tries to tell you that they have, I'm 99% confident that they're lying. And the result is we get a distribution of how the future looks like, aka their potential returns, or in the industry we call internal rate of return. which they collect fees by how good they're performing or how
Right.
bad, penalized for how
Right.
bad they're not.
How fast you get that capital invested back.
Exactly.
So, okay. So there's a software that you're working on that's gonna play a role in helping large institutional players. In the world of startups, you're entering an industry that already exists. Who are the existing players that you feel are sort of doing touching on some things where improve existing handling the existing transactional process and forecasting that you're aiming to kind of beat.
Hmm. Well, that's good question because first, I really want to let you know what we're eventually building.
Mm.
Because what we're eventually building is an autonomous investing agent. In the world of self-driving is
Mm-hmm.
L3, autonomous driving or autonomous investing in our definition, meaning the majority of the work is autonomous.
Mm.
But some of the major decisions still require a human to make. Like
Mm-hmm.
when you're driving your Tesla Model S, well, you still want to make sure that your hands are on the steering wheel, which in the world of institutional real estate investing is you still want to make sure you have a world-class investment committee who can observe more things other
Mm-hmm.
than the sensors of the machines. And that's actually how we see the future of AI and the human is humans are better sensors that complement machines. So with that goal in mind, and we just do the backward like propagation. So it's like building the self-driving car, but you don't really have a Google Maps. You don't have that technology yet. So we have to go, take one step back. So we need to build, helping the industry modernize first,
Mm-hmm.
and that's where we are. So in terms of the competitors, of course,
Right.
there are some major competitors like CoStar. I don't think they are our real competitor because they focus more on the data infrastructure as well as Argus. They're really great company. Like the software has been here for 2 decades.
Right. I've tested it out before as well.
Yeah, and I don't think they're going away. And what we see as the biggest competitor, to be honest, like 100% honest, is Excel. Is an existing solution, Excel plus human,
Mm-hmm.
and that's actually our biggest challenge. People don't want to change. It's like you will try to modernize Ford.
Everyone uses Excel. It's
Exactly.
one of the biggest business tools on the planet. It's retained its dominance for
Exactly.
decades.
Exactly.
At least 2 decades, I would say, right?
Well, more than 2 decades actually for now.
Yeah.
Yeah.
But what given the dominance of obviously Microsoft and workspace enterprise productivity, what would cause a institutional buyer, let's say, and a GP would be the ones using this, would you say, or is it the LPs that were doing?
GP first and then LP.
Okay. So for these players who have access to the best enterprise software tools out there, you know, and have the best human talent likely out there that would be able to use these existing software tools to a degree, of course, that would allow them to do all that they are currently doing in this analysis. Why is your startup, why is your software gonna be able to shift them away from that towards an entirely new solution that they would have to learn, just as Argus, when it came out, it's a new tool. How do you get people to transition to something entirely new?
Yeah, that's a super good question. Actually, what we're trying to solve is, well, that's just humans are not the perfect product in capitalism. What I mean by that is nothing philosophical. It's just no one will work as an analyst for his or her entire life.
No,
That means
certainly not.
the labor market is the stock flow model. I mean, people needs to be promoted or they will leave.
Of course, you do it for a few years and then you get promoted. You do oversight. You look at more complex deals. Then you eventually become management. So, you don't imagine anybody working as an analyst for more than like 1 to 5, let's say, years generally.
Exactly. And in our pop culture, let's say, of Wall Street or any financial institution, this is kind of miserable life. You're doing junior analyst for his or her life
Yeah.
and then retire, right? That's actually a challenge where I saw when I was working as a private equity analyst and then an investment manager is because the shops are usually not that large. It's not like commercial bank. You have a squad like 10,000 people working on the writing team, nationally or internationally. Sometimes one person, he or she was responsible for sourcing the deal early days, but then maybe decided to go to MBA program, leaving for 2 years. And then when things go wrong, and when we were reviewing the we call LPA, Limited Partners Agreement, stating our obligations and the rights, and then we realized, okay, so who actually negotiated that? And the person is no longer with us, at least for now or permanently. That means our domain know-how, internal and in-house know-hows are gone. And the industry standard, of course, you standardize the whole thing. You let everybody input everything into a structured database. The challenge was you just increase the inefficiency so much. When I was working there, that's really the least thing I want to do, because the time I should be spent is on finding the next deal that can 10x the dollar we put in, or making sure that we don't screw up when we're presented a really, really good opportunity, which 90% of the time there's a catch. But, it's like you have a limited amount of time as an owner or manager. You literally buy someone's time to do the things.
Right.
And you want to maximize that. You don't hire someone from HBS just to let them doing the boring task. This
Right. There's an automation element there. But so I guess for the people, again, working on this using the traditional software tools, how do you get them to shift, right? Ultimately, what's the value?
Yeah. So right now, we try to keep the workflow as same as possible. So essentially, we don't want to build another Excel, because it's really a waste of everybody's time. And we can, so far.
So you don't want to build another Excel, but you want to keep the work process the same as possible.
That's right.
What does that mean?
We incorporate Excel and Argus in our workflow. So we just want to make sure the experience, just imagine your partner of Whitestone LP. It's just like investment analyst. You chat with him through email. You present this is a deal I received from Francis. He wants to offload his office portfolio in downtown LA. We know the market is not that good, but hey, Apers, you want to look into the local market. Tell me the demographics, and I want to see a short due diligence before we put real money to the lawyer, to the engineering team. Give me a short due diligence if there's a catch, and give me, it doesn't have to be like monthly cash flow yet, but show me the annual cash flow pro forma in Excel using our internal model.
What, I guess, the biggest question, it seems, is you're trying to automate this. You're trying to use AI in some way for this. A lot of AI companies out there, a lot of people pivoting to using AI in some way, because that's not what's hot right now. What is to stop, let's say, OpenAI from creating some sort of tool that does a lot of these calculations?
Well, that's the defensibility question. We really don't see OpenAI as our competitor because one, it's a very niche market. Meaning, actually, another example is why there's so many residential focused startup in Silicon Valley, but very few in the commercial real estate space. Because even it's the third largest asset class in the world, the people who are, devoting their life in this industry is not so tech savvy. It's usually relationship driven, and they're, in comparison to the residential brokers, there are just a few. Look at the pension fund. Usually their real estate team is just no more than 50 people. That's including their property management team. And usually some of them just don't keep them in-house. 20 people managing multi-billion holdings.
Yeah.
They cannot afford that many people working for pensions, so they outsource that to GPs. So back to OpenAI, because eventually we're building the the autonomous investment agent, and we want to position ourselves into the we call syndication part of real estate, equity part. We're not replacing GP, but helping them using equity money more efficiently.
How does this, what do you mean by automating or like, using AI to kind of creating this investing agent? Because you need the human, you guys mentioned you need the human element to finalize things ultimately. Who is this more for the GP? Is this more for the LP? Who is it really? Who would this more final product be in your mind?
So let me just give you an example. Like William, you want to start your own private equity after working a few years after your MBA journey. Let's call it again Whitestone Limited Partners. So usually when you're acquiring a deal, you of course go to the debt instrument or banks, right? And usually they provide the largest portion of the capital or on the capital stack. Usually 70% or 75 to 80% if you guys know each other really, really well, they trust you. And the challenge for you is, one, how can you use more other people's money? Because the more other people's money you use, the higher internal rate of return you can have, which is leverage. Of course, you can go for mezzanine or all kinds of that, but where we see the future is increasing the debt on your capital stack is just too risky, and we believe the future will be a real estate syndicator. For example, Apers, we provide the equity portion. You can still collect more fees, right? And we provide the equity part because we're so good at analyzing and pricing the risk we are taking.
Okay.
So the bar for you to start your own private equity is way lower.
Okay. So you're saying for a GP perspective, if somebody has their own fund, they want to invest, you have options essentially for your company for them to invest.
That's right.
So wouldn't that mean you're kind of acting as sort of a GP in this situation, or you would perhaps appeal more to LPs in that situation?
Yeah. Well, just like what Oscar Wilde used to say, to define is to limit. And what we see the future of real estate market, private real estate market, is much similar to what happened to the public equity market for the past 100 years.
And what's that?
So, just imagine, let's just go rewind 100 years ago before the Security Act of 1934. So it's, largely relationship driven. You need to know the right person or people on the street, Wall Street. And the trading is, people literally trade paper stock certificate. That was a time you don't have automated rebalancing. But today is different, largely because one, you can get the exposure of the security market fairly affordably, like Vanguard. They're not trying to be the smartest person in the market. They're providing an affordable vehicle for investor to get the exposure and leaving the difficult and challenging but rewarding part to hedge funds, where they call alphas. And that's where we see the true value of real estate investment manager. You can create values more than someone who's buying, Vanguard Real Estate Investment Trust ETF. You need to go beyond that. And that's the part where you should be truly compensated. Where LPs should really pay you the fee. But that there's a huge market that's not being created because unstructured data is so difficult to analyze.
As you mentioned, this really critical element piece, which is for LPs, they're paying a cost. They're getting the profits, but they're paying a cost up front and over time for GPs and, let's say other investing entities to invest the money that these LPs collected to really produce value back. What are roughly those transaction costs, right? And what does your company intend to do to kind of minimize or add value back to the LPs, let's say? And where does your ultimately venture, right, become profitable in itself? Like, where does it provide value to gain value by itself as well?
Super good question. So we are a for-profit company, corporation,
Right.
and our goal is to maximize the shareholders' value. So real estate is really easy to do the number game. One, we charge subscription fees for people who are using the software. Let's just imagine in a world where we totally devote our energy on self-storage, autonomous investing, right? Well, there are roughly 50,000 properties managed by public REIT or REITs. $99 times 50,000 times 12. That ARR will sustain a $3 billion company. And that's just like the tip of an iceberg portion of real estate. But where we see the future is way bigger than that. Just imagine an autonomous investing agent for private real estate as a syndicator. Okay, Whitestone is still the GP. We provide the rest of the equity money you need, and we can charge 0% management fees, 20% performance fees.
Interesting. Interesting model.
And you subscribe to the software because we use so few people to handle that. And you are a local guy, you still charge your 2% or even more because we still need you to.
The management fee.
The management
right.
fees.
So let's say a company like would raise $100 million. They would charge a 2%, maybe 2.5% if they're like very good. So, 100 million, you're getting them 2 million, 2.5 management fees. And you're saying in this case, you would charge 0%, but you would charge a subscription fee, I'm sure. Maybe that would probably be a little bit less than 2%, perhaps.
Absolutely.
And that's the value provided, essentially. And then you would aim to get 20% of the profits in the situation.
Exactly.
But would that be 20% of the profits of the GP who gets 20% of the profits, or how does that work?
Well, it's a very detailed question.
Right.
But usually we charge like the based on IRR and how fast we make money. But in this case, the reason why we have 2% is something I really want to share with you and the audience, which in the industry is being quite controversial. You, as a pension contributors, like your retirement money, is going to pay for someone 2% every single year, no matter what happens, is intrinsically conflict with your interest. And actually, that's a lot of companies I have seen, at least. They might not be incentivized so much to maximize the 20%, or sometimes they just cannot. They can promise a 50%, but they just cannot. But the time they keep your capital is a time they make money.
Interesting.
But that's not to say that all of them are evil or something. No, because humans are essentially valuable and unique. People have their constant periodical consumption of service and goods. We have a place to live, right? We need to eat, and you need to sustain that. So having people is just really expensive. And sometimes for smaller shop, we're not talking about like Blackstone, Brookfield, $1 trillion AUM. We're talking about like $100 million AUM, asset under management company. 2% maybe just barely can keep their lights up.
Right.
It's not they're trying to scam you or something. But that is at least what I see, the intrinsic conflict of interest. People try to solve that with 20%, making me money fast can give you more, maybe even 30%, 50% as an incentive. But that rationale doesn't hold for, more less risky properties. Just imagine there's no way that we can double the value of Prudential Tower in a year. It's in pretty good shape.
Right.
We just want to buy it and collect the rents to support the pension contributors or people who just retired. That's the contract we signed a couple of decades ago. But the managers still collect fees on it. That's the ultimate $1 trillion challenge Apers is going after. Solving the principal agent problem using machine. And that, my friend, is really what I believe, where I don't see many people realize that. Principal agent problem elimination.
That is definitely interesting, and that would certainly disrupt a lot of the incentives and financial models that current and institutional investors really are utilizing, right? In order to remain as a viable and profitable entity that provides value for those that invest with them. Do you think that there is more to kind of resistance perhaps to this rechanging of the model, because the 2%, let's say, management fee, right, has been here for quite a while? How does that, why would one want to change, right, and use something new and essentially drive down their own value that they're extracting essentially from this, right? As you said, they have an incentive to keep your money. Let's say lock it up for 5-10 years. You're getting 2% a year. You're getting 10 to 20% of that money essentially for management fees over 5 to 10 years. Why would they want to change?
Well, one, I hate to make a pop culture reference of Thanos, like in his famous Avenger 1 or 2, dreaded, run from it. Destiny comes all the way, all along. Because this market is a competitive market. When you can get the same things, like same apple,
right,
that one is cheaper. In the long run, market equilibrium is the one who's charging less, taking over the market. Is nothing magical. It's just the basic economic principles. Just look at the National Association of Realtors, if you are following the news, where we used to have 6% transaction fees paid by the seller, split between the buyers and the seller's broker. That's at least a 4% above market globally. It's been here for a while. They managed to create modes to protect their 6%, either using MLS system. But market, that's just taking a super high level. Markets will correct the arbitrage opportunity eventually. So that's, to answer your question, we are willing to be at least part of the movement, right? It doesn't mean like we're replacing everybody, because the amount of untold story or the unobservable, unstructured data in real estate is not going away, right? We still need people to locate the property, finding the value add opportunity or opportunistic real estate investment, properties on site or by brokers, not going to be replaced. But what we are replacing, or the players we are kicking out of the market, is the one who is being dishonest, who's scamming their investors, who just want to collect the 2%, getting we call core or core plus, meaning just holding the asset, stabilized, or using the term is, I don't want to get too technical, but just imagine we hold 100 apartment building in New York City, 4 floors, and someone tries to collect 2%, barely doing very little thing, let's just say, in terms of value add. We are, at least that's on our roadmap, to replacing them, because they shouldn't be charging 2% every single year for your retirement money. If they're helping you make 20, that makes sense. But if they're just making you 6%, getting 2, that's a lot, my friend.
Absolutely.
Over a period of time, compounded.
Absolutely. Well, tell us a little bit for this last segment about, your startup itself. Let's run through that, right? You work on this for a year now, and before you worked in private equity real estate, right? So you've seen how the player industry works, essentially at a large scale, in the billions of dollars, right? You I'm sure paid very well in general in private equity, but you chose to leave that, and you chose to work in the startup for the past year. Run us through kind of that mindset, right? Why choose to leave that? Yeah. Why do this? And then we'll break down to the startup itself.
Great. I'm glad you asked, because, it's actually part of me, because I really love taking ownership of my own activity. I don't like being a tool, even though I'm a pretty good tool. I always execute and deliver, but I think for majority of the entrepreneurs or people who are creating their own business owners, they ultimately want to be responsible for their own decisions. That's a true risk they're taking. So actually, back to Apers. Actually, I wanted to do this back in 2019
Mm.
when I got here. And then after 1 year, I was like, okay, this is like way ahead. Academia is way ahead of the industry. I
Mm.
really want to do it. Um, so actually, I talked to a lot of people in the industry, in Asia, in here in the States. I just want to know how, like, what's the industry right now, right? Surprisingly, is not there yet. Let's just say. But another major thing is there's a technical challenge
Okay.
that we didn't solve. For example, the biggest challenge is how to deal with unstructured data.
Mm.
A very specific task, like the deed you have, is usually scanned.
Right.
Probably signed 100 years ago. Actually, the property we just acquired it was built in 1890s. You can still see the signature of the mayor by that time in Boston. How do you convert that into something analyzable? And how would that impact your rental income, the expense? What risk could be associated?
Hmm.
And usually, well, NLP was not there yet. And the amount of time, the engineering you spent on that part, the automation part, is actually a lot more than just hiring an intern from Harvard or MIT and pay them pretty well.
Okay.
So that was a challenge. And I was like, okay, one, I don't know the industry long enough.
Right.
Two, technology is not ready yet. And if I were to choose take any venture money, which is a very expensive capital, they expect you to double or 10x
Right.
every single year. And I don't like disappointing people. I don't like burning others' money and walk away. So that's actually the main reason why I didn't do it, which is an experience I want to share with you and the audience. Is sometimes wait is also a good strategy. And then in private equity, of course, the industry is way outdated than I expected because I did so much option pricing, asset pricing models, all kinds of, stochastic discount factor, consumption-based cap M. And then my first day of work is, hey, Francis, you want to copy and paste those PDF files into our Excel? I was like, okay, sure, but I don't think that's the best way to use your money, right? But anyway, I did that anyway. But that's the industry, like the current stage of the industry.
Yeah.
So to really answer your question, why I choose to start this is one, working for a company is essentially selling call option. What I mean by that is you sell the upside for a pure auto cash flow. Sometimes you get a split, like a very small split of the outcome, just to prevent the principal agent problem, to align the interest between you and the employer. Different people have different risk preference. I know some people are really risk averse. They're pretty happy with pure auto cash flow. They can spend more time on their other things, their hobby or their family. But for me, at least, I prefer taking risk.
Okay.
And because taking more risk doesn't mean you can get rewarded, but getting higher reward means you necessarily took higher risk.
Okay. So you chose that you want to take a higher risk on this, and the technology wasn't there at that point. So now you've worked on this for the past year. For our audience who are also looking at building ventures, how have you chose to fund this venture? How have you chose to build the team of co-founders?
Yeah, great question. So let's just say capital is quite important because without that, no one can work for free because they have a pure auto cash flow going out. So number one is, of course, we took very little money from a local investor. They choose to trust us and write us a very generous terms check on cap and safe MFN. Basically, they just blindly trust us. And I value it very much because that means someone trusting you is the hardest thing you can have in the early stage.
Okay.
And another is, still self-funded because you want to, de-risk enough for your venture.
Okay.
Before you're officially taking other people's money. Otherwise, it could be very expensive,
Hmm.
expensive in the term of like diluting your company a lot before you're really taking off, and that disincentivizes your team when
Right.
you dilute too much.
Okay. So what is kind of for yourself? You said you raised a small amount and you're funding the rest. What does it look like for yourself for and expenses, right now in the past year? Are you burning cash, significant cash?
Hmm.
Like, where is it fairly manageable?
Yeah, it's a fairly manageable because I'm quite fortunate because usually when you are working in real estate, the size of the deal and the reward for doing the deal successfully is a is a little bit higher than the money you need for startup companies, and the all kind of data infrastructure we have here in the states, you can really keep your expense low.
Mm,
So for us, we're pretty good for now, and the cost for any API of the like language models are getting cheaper and cheaper.
hmm
For us, that's a good thing. Yeah, so we because we know right now we're in a high interest rate environment, and you don't. The last thing you want to do is, if you're really passionate about your venture, is sell yourself cheap. Right?
absolutely. So I guess for yourself, do you imagine yourself taking on venture money at some point, raising a Series A or even a seed series, and then a Series A, B, and so on? Is that kind of the traditional path line
Mhm.
of a startup venture? Is that something you're imagining for your
Yeah.
startup?
Yeah, actually, we see that more like dessert than oxygen.
Hmm.
The reason is one, these private markets are still convoluted. It's
Hmm.
like, you're going to finding a new continent. You want to make sure at least somebody trusts you with a compass, right? So that's the relationship we're seeing. And the only way to tell if someone or some organization, institutions are truly trusting you is, do you want to put the money here? We will make sure that we de-risk enough
Hmm.
for you. We might not even necessarily need additional external capital, but we take this as an opportunity to work together.
Mm.
So that's our mentality.
Hmm.
Because right now, to be honest, is the worst timing to risk equity when you have a risk-free rate over 4 to 5%.
Hmm. Absolutely. Okay, so it doesn't look like you're going to be raising money and you're bootstrapping, which some startups do, some startups do not. Tell us about your team and how you're kind of really assembling this, because you're the co-founder of this venture. Most of the other guests I've had on, most of them have also been co-founders, either a team of two or three. What is it like for yourself?
Yeah, so I do have some lessons I want to share because in the early days, this company looks very different.
Hmm.
We were focusing on the AI safety space, believe it or not,
Hmm.
and the co-founders were, two fabulous engineers. We built a product, and we actually published a paper on Europe's the workshop, and we get the academia endorsement, products
Hmm.
there. And then we realize, okay, so finding a product market fit is fairly difficult for any risk based product,
Hmm.
especially in the early days where people are fascinated about the potentiality, not the danger of this new technology.
Absolutely.
Yeah, so we eventually, because I think the philosophy we're having is you just cannot force people to work with you, right?
Yeah.
And eventually they decided to do something else, and which I personally I'm really thankful for the time they spent with, and then managed to build a whole new team,
Hmm.
which is my new co-founder and his. But this time, it's like the lesson I want to share is you really want to put the hard conversation early on.
Mm.
Hard conversation like equity,
Hmm.
right? Half a half, or you want to take small percentage. Take small percentage doesn't mean half major, or it means the value you provide is very limited. Full time, part time. Do you want to join this game? As like going all out, or just want to do that as a hobby? And because the latter one usually will kill the company. Moving fast is the only advantage a small company has.
Mm.
Moving slow, that's a luxury of corporations. some other conversation like, what if it doesn't work out? Do you want to pivot? If so, what kind of industry do you think we could pivot to?
Hmm.
And something you don't want to do because you just don't know that at all. And that's actually another friend of mine who built a really cool, like a chat software several years ago, but eventually she decided to pivot into healthcare. Then she lost 90% of her team members because they have no idea how that part of world works. So you really want to have the conversation early on, and
Hmm.
luckily for us, we have the YC questionnaire. 10 questions to ask. It's not like a 100 questions, just 10 questions to ask and 10 questions to get other people know you better and know other people better for your team and just see if this will work. And that's actually the biggest advice I want to give is having hard conversation is an essential and a necessary skill you need to have if you choose to jump on this high risk, high reward game.
Absolutely. I think that's good advice for any entrepreneur who eventually wants, whether it's now or wait a few years, they have to have these critical conversations because if you don't and you have them too late, then it might very much impact whether your venture continues or not.
Precisely.
Well, Francis, thank you very much for sharing insights into both the critical issue that you're trying to tackle and this new venture that you're building.
Thank you, William, for having me, and thanks for all the listener.
Absolutely.
All
Cool.
right.